Pete spent 22 years building what looked, from the outside, like an enviable real estate empire. He started with one rental duplex at 30, leveraged the equity to buy a second property 5 years later, and by 52 owned 6 rental units across his metro area, worth a combined $2.1 million, with roughly $1.3 million in equity after outstanding mortgages. Everyone at family gatherings treated Pete as the obvious financial success story of the group. His college roommate, Aaron, took a very different path, investing the same amount of capital and effort into a simple diversified stock portfolio instead, never buying a single property beyond his own home. When the two of them finally sat down and calculated actual returns, factoring in every cost Pete's real estate had generated over 22 years, vacancies, repairs, property management fees, insurance, property taxes, and the value of his own unpaid weekends spent managing tenants and handling emergencies, Aaron's stock portfolio had produced a comparable total return with a small fraction of the time, stress, and risk Pete had carried the entire way. Real estate always wins is one of the most confidently repeated pieces of financial wisdom in America, and it isn't baseless. Real estate has genuinely built enormous wealth for millions of people, and leverage, borrowing a large portion of a property's price through a mortgage, can meaningfully amplify returns in a way that's much harder to replicate safely in a stock portfolio. But the version of this claim that gets repeated casually, that real estate simply and reliably outperforms other investments, almost always compares the wrong numbers, headline property appreciation against a stock index, while quietly excluding a long list of real costs that meaningfully change the actual comparison. The first excluded cost is ongoing cash expenses that never show up when someone describes their property's appreciation. Pete's 6 units, across 22 years, required roughly $340,000 in combined repairs, maintenance and capital improvements, expenses that don't reduce the sale price he'd eventually quote a family member, but absolutely reduced his real, all-in return. Property taxes and insurance across his portfolio ran another substantial amount annually, expenses stock investors simply don't carry on their holdings at all. When Pete calculated his actual net cash flow after every real expense, several of his early years were essentially break-even, or slightly negative, a detail that never appeared in the "My properties are worth $2.1 million now" version of the story he told at family dinners. The second excluded cost is vacancy and tenant risk, an unpredictable expense that real estate investors frequently underestimate until they've experienced it directly. Over 22 years, Pete's properties sat vacant for a combined total of just under 14 months, generating zero rental income, while property taxes, insurance, and mortgage payments continued regardless. One particularly difficult tenant caused $19,000 in property damage and took 8 months to legally evict, an experience Pete describes as one of the most stressful periods of his adult life, financially and otherwise, a risk category that simply doesn't exist for an investor holding a diversified stock index fund. The third excluded cost, and the one Pete himself acknowledges is easiest to forget, is time. Across 22 years, Pete estimates he spent an average of 6 to 8 hours a month directly managing his properties himself in the early years, before eventually hiring a property manager at 8% of collected rent, an ongoing expense that further reduced his actual net return. Those unpaid hours, responding to a broken water heater at 11 p.m., screening tenant applications, coordinating repairs, represent a real cost that never appears in a property value calculation, but represents time Aaron spent entirely differently, having chosen an investment that required essentially no ongoing labor once the initial decision to invest was made. None of this means real estate is a poor investment, and the leverage available in real estate remains a genuine, powerful advantage unavailable in most other asset classes at comparable risk. A property purchased with 20% down and financed for the remainder allows an investor's equity to grow based on the full property value's appreciation, not just their initial down payment, an amplification effect that, when it works in the investor's favor, can outperform an equivalent unleveraged stock investment substantially. Several of Pete's individual properties, evaluated purely on appreciation relative to his initial down payment, did produce genuinely excellent leveraged returns. The honest comparison isn't real estate versus stocks in the abstract. It's leveraged, actively managed, illiquid, labor-intensive real estate against unleveraged, passive, liquid hands-off index investing, two entirely different risk and effort profiles that happen to get compared as though they're interchangeable whenever someone says one always wins. Real estate's leverage advantage comes bundled with illiquidity. You can't sell 10% of a rental property to cover an emergency the way Aaron could sell a small slice of his portfolio, concentration risk in a single property, city, and tenant pool, and an ongoing labor requirement that functions as a second unpaid job for as long as the properties are held. The investors who do well in real estate specifically tend to genuinely enjoy, or at least tolerate the operational work involved, treat it honestly as a part-time business requiring real skill and time, rather than a passive investment, and calculate their actual returns including every real cost, rather than simply subtracting their mortgage balance from an estimated current market value and calling the difference their return. Pete, to his credit, has come to appreciate this distinction more clearly in recent years, and now describes his real estate holdings honestly as a business he built and actively works, rather than a purely passive investment that happened to outperform his college roommate's portfolio.